Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis, to 2026, first episode of Taking Stock. But in the grand scheme of things, it is episode number 65. Welcome to 2026, Art Jarvis.
Happy New Year. How are you?
I was waiting for that. I am well, sir. Thank you.
Okay. So today's what, the 13th? So we're getting pretty close where I can't say Happy New Year anymore. So, but I'm glad I got to do it at least one more time.
Can't you say it all year long?
I mean, technically, they might make fun of you.
Happy day.
You know, I don't care, so it's fine.
Well, you know, it's a new year for me starting yesterday.
Is that right?
Why, sure. I mean, I went on hiatus.
Oh, that's
beginning
true.
the 19th of December was the last day.
Good point.
And yesterday was the first day back. So thank you. Happy New Year to me.
Yeah, there you go. So you're back in business.
Back in business. Not that it really ever stopped 100%.
Yeah.
And you know, with thanks to some technology, there were times I'm sure people thought Loveland Beacon was kicking live and going ham that day.
True.
But there were things that happened. I mean, I did attend an event or two to cover them and be able to share those stories while I was supposedly, on vacation. But so yesterday was officially my first day back and the first day of the new year off the hiatus, as it were.
You know, as I've said to you many a times, I think it's a really good thing that that we actually have someone in Loveland who is a reliable professional that gives us some decent news and things like that. Gives you both sides of the story. So, but that being said, I do think it's also important for you to get a little bit of time off and refresh like everybody else. So, I'm glad you got some time off, but I'm also glad there was still a steady stream of some news coming during that time too. So thanks for that.
I have two words. Aw shucks.
Aw shit. Not aw chucks.
No. Not at all. Aw shucks. But thank you. Those are the other two words.
No, it is important. I don't care where you are, if it's Cincinnati or Ohio or what. You definitely need a unbiased delivery of the news, and we both grew up back in the, for us back in the 70s and stuff where, in my humble opinion, the news delivered the news, not a steady stream of editorials. So
things seem to have changed.
Just
the landscape of, news writing and newscasting and the news business, the landscape for journalism has certainly changed. It's an interesting thing too that you say that. I appreciate the compliments and I try real hard. I am blessed to have learned from one of the greats in the industry, and I say that, and because he's on my mind today anyway. Today is Nick Clooney's 90th birthday.
Is it really?
Yes, and I was fortunate to have Nick as a mentor when I was a young, television news broadcast intern at the old Eyewitness 12 News when Nick Clooney was the anchor and news director. So I learned a lot from Nick about how to do it right. I hope that I am applying those lessons, and so I thank you for your kind words that indicate that maybe I am.
Well, that's a neat little fact there, number one, but that's a heck of a trivia question. Yeah, you know what I mean? You kind of get into a group, friends and family kind of group, and did you know?
Right.
Well, that'd be a good one. Yeah.
Well, this isn't the place. We're on Taking Stock episode number 65. But, there's a lot of great stories from being a part of that team with Nick Clooney, and there's a whole bunch of other names. People around this area will probably, Ira Joe Fisher did the weather, and Denny Jansen was, sports, but mainly Walt Mayer.
Yeah. Wow. Yeah.
Known as very fondly identified as the Grand Poobah. And again, a mentor, because my main focus then was sports. And so to really be under the wing of Walt Mayer, and then in the news aspects under the wing of Nick Clooney, I don't know where you get it better.
Yeah, that's
I could really throw.
You could do a lot worse.
I could really throw a trivia thing in, which is one of the stories, and then we will get right down to taking stock. But in high school, the thing that inspired me to move toward broadcasting and broadcast journalism was had the opportunity. There was a program called the Explorer program, and I think there's still Explorers.
Right.
But our Explorer program that I got an opportunity to get involved with here in Cincinnati took us to Channel 9 in Cincinnati, WCPO, Channel 9, at the time a CBS television affiliate, with Al Shuttlecotty News. It wasn't Channel 9 News, it was the anchor, Al Shuttlecotty News. Unprecedented leader in the television news business. In Cincinnati, Al Shuttlecotty News was number one. No other station had ever been ranked number one in the TV ratings besides Al Shuttlecotty News. And I was fortunate to be there while I was a high school sophomore and junior.
Nice.
And get some, tutelage, if you will, from Al Shuttlecotty and the gang there. Jack Moran in sports. I mean, the names are, it's crazy. But Todd Hunter, some iconic names in television news in this city. So it was a blessing. But I don't know, and all of that, and hopefully I'm not putting those guys to shame because they're like, oh gosh, don't tell them we
don't tell them we're responsible.
Yeah, we did that. But
that's good stuff.
Some really neat stuff. But the last piece of that though, which I'll throw in. So this I'm not trying to correlate this to me, but the interesting thing was, so I was there at Channel 9 with Al Shuttlecotty and learned some things, and then during college, internship at Channel 12, when the Eyewitness 12 news team, led by Nick Clooney, won the ratings book for the winter ratings book in 1982, might have been 81. The first time ever Al Shuttlecotty News was not number one.
Yeah.
I'd been there, and then I was at 12 when, and trust me, it didn't correlate to my contribution at either one of those organizations.
But some people would beg to differ. There's a correlation now. Whether it's a good correlation or not, that's
I'd love to claim responsibility, but one thing is for a young guy trying to make his way and learn something in the business, it was some special moments.
You were in the right place at the right time a couple times. That's good stuff. Sure.
Anyway, so now all that, and you're so happy and you're so nice to me today, and what I'm going to do is say, Art, last year at this time, you made some predictions. You forecast the what we just call them the 2025 taking stock predictions.
Yes.
And I loved your line at the time, which we've held on to, buckle up.
Buckle up.
Because the forecast for 2025 was we were going to ride a roller coaster, probably.
That's funny. I forgot that we used the buckle up until I pulled up my notes from last year.
And you and I have the same note sheet.
Yeah. But it's interesting to me that not long, so a month and a half after we did that prediction show was middle of February, we started the whole tariff business.
Boom, it didn't take long.
And next thing you know, by the end of April, the market's down 20%. So that definitely, I was like, well, that falls under the phrase "buckle up," because it's kind of like being on an airplane and hitting a major air pocket, right? You better be buckled up. So
I was going to say the seat belt ripped loose.
Oh goodness, it was
in February, March of 2025.
I'll say it. It's important to analyze the reasons why things are happening in the markets, okay? Because there are good reasons for things to cause the market to go up and down, and then there are nothing more than just uncertainty and a whole bunch of rhetoric that doesn't really fit. And we dropped 20% because of our fear of the tariffs, but it never correlated with the economic numbers.
Yeah.
So if you stayed in 2024, you were rewarded nicely. Okay? Now, the other side of the equation is if you did get out for some reason, but then you got back in at the end of February, you were exceptionally rewarded in 2025, right?
Yeah.
I mean, I think from the bottom, I think the market was up like 37% or something like that. So, yeah.
Yeah, there were great gains, and as you said, if somebody had left for some reason during the end of 2024, and then some reason jumped back in at the start of the where we began to regain our footing, we'll say, yeah, they reaped some real rewards in 2025. So which brings us down. So we're both looking at the same notes.
Yep.
Even though we're sitting across from one another, I have a number one stock market. S&P 500 hits 6,900.
Guess what?
Where are we today?
Well, today we're at 68 something. I think today we're at 69.60. So
we're going to check that off.
Yeah. So we hit 6,900 before the end of the year last year. And matter of fact, it was really basically the last 3 days of the year last year. We gave up a couple of percent because there was a lot of window dressing, and there was a lot of technology stocks. People were doing profit taking. So we actually finished at 68.45. So if you're going to go by when it finished,
I gave you a check mark.
You gave me points. Okay, then I'll show you.
Because today, as we open the 2026 calendar year of taking stock, you're slightly over the 6,900, and we know that we did pass. S&P 500 went over 6,900 during 2025. I'm not going to hold your feet to the fire and say, hey, you said it would be at 6,900. You said your forecast was the S&P 500 hits 6,900. It hit it, and then it stumbled around in second base, fell face first into third, and maybe crawled home.
It crawled home.
But anyway, so that's a check mark.
Well, if you're saying that's a give me, I'm going to take the give me. There's a rule in golf: if someone says that's a give me, you take it.
Well,
so I'm going to take it.
Pick it up.
That's right.
You made that. Pick it up and walk, and we're going to the next tee box. All right, in the next tee box, your forecast was 17% from the end of 2024, which referenced the growth of the stock market, right?
Of the S&P 500 total return index. So we finished up. So we're looking for a 17% return based on that 6,900 number.
Right.
We finished up 16.4%.
Ooh, that's a just missed.
Yeah, just missed it. But I will make for those who are interested. Once again in 2025, the S&P 500 capitalization weighted index, which is heavily weighted toward technology still, was up 16.4%. But the unweighted index, which just takes all 500 companies and treats them equally, was only up 8.5%.
Ouch.
So there's a big difference between what that index did and what the overall market did. So I will point that out, though.
Well, we'll move quickly on to under stock market, as we're talking about the forecast for the stock market. So under stock market, we talked the S&P 500, the 17% increase, which was 16.4 for the S&P, and then 14% from the close of the market that you forecast from on February 3rd, because when you made these predictions was right at the end of January of 2025, and the next thing that was going to happen was a February 3rd reporting, right?
Yeah, because January was a good month and half of February was a good month also.
So I'm guessing that you're going to say we hit over 14% after the close on February 3rd, yes?
Well, what I would say is if the 17% number up above that is correct, then the 14% number should be correct.
That's why I skipped right.
I didn't actually calculate
so
that.
You get a check mark there. So then, and in the notes, the next item, we're still on the S&P 500, 320 in the S&P 500 earnings.
Mm-hmm.
And this is where the people you're going to have to talk about it, because the 21.6 market multiple.
Yep.
which means what?
So basically, if you take all 500 companies that are in the S&P 500, add up their yearly per share earnings, the prediction was somewhere in that $320 per share of S&P 500. So, but yeah, so that ended up actually was a little light. It was at 315.
Okay.
And
well, we got a plus or minus in there.
Yeah, and the market multiple was not 21.6. It ended up being 22.
Oh, so now that's where I say explain to me the 21.6 ending at what was it?
At 20. The market multiple ended at 22, which is basically the level of the S&P 500 divided by the earnings for that year.
Okay.
So if you take the number divided by the earnings number for that year, you should come up with around that 22.
But then the simple question for everybody listening, so a 22 instead of 21.6 is not as good as a 21.6, or it's better than.
Actually, well, I mean, if you're trying to say whether the market is cheap or expensive, a 22 number would be saying it's slightly more expensive than what we were shooting for. Yeah. But
well, I was going to say, since we were using the golf analogy,
yes,
no gimme on that one.
Oh, come on!
Because you were a high of 22 instead of the 21.6. You needed a 21.6 at the turn to take it to the back nine. And
you're right. You are going to be tough. Yeah. Jeez, Pete.
Well, hey, I gave you a couple of gimmies. Come on. I still gave you a check mark on that, despite we gave you the plus or minus. It was not 320, it was 315, and we gave you a yes on that forecast.
Okay,
as well.
All right.
So the stock market will equate to a Dow Jones. You know how much you and I love talking about Dow Jones Industrials. We don't, but anyway, equates to a Dow Jones Industrial average of nearly 51,000. How did we look at the end of the year?
Well, so that I guess based on your toughness here, I would have to say that was a miss then, because if it had gone up 17% on the Dow Jones, it would have been at or near 51,000. But as I mentioned, that it was more of a technology-driven market. The Dow Jones index did not go up as much as the S&P because it has less technology. Yeah, so it ended up at like 48,500 or something like that. So it missed by a couple thousand. So
now percentage points.
Yeah, you want to go into percentage?
Well, I was going to try and help you out on a plus or minus.
It's still a miss.
All right. Okay.
But like you said, I don't care about the Dow Jones.
The bottom line is, what we're just trying to, the whole purpose in this exercise is, and as you will, indicate some forecast for what's going to happen in 2026 when we get through it. It's to give the people an idea. But when we're looking back, how'd you do? I think it lends to, does Art Jarvis and Taking Stock know what the heck they're talking about? I mean, can we listen and learn?
So some days yes, some days no.
Well, the market is going to do what the market. What do they say? The wind blows as it wills, right?
That's true.
The final stock market forecast for 2025 had you talking about out of the 12 sectors. Look for technology, financials, industrials,
correct,
and consumer cyclicals,
correct,
and healthcare,
to
lead. Well, that covers a pretty wide range, but technology.
That's five out of 12 sectors. But interesting enough, so technology was the first pick. It actually finished number one. Financials was the second pick. It finished number 4. Industrials was the third pick. It actually finished third. And then consumer cyclicals snuck in there. Did not sneak in there. I apologize. I had that at number 4. It actually came in at number 8. So it slid off a little bit. And then healthcare was number 5. It didn't make the top 5, but was number 6.
Okay.
So I can live with that.
Well, you had 4 out of the 6.
Yep. Yeah, exactly. So 4 out of the 12, really. I mean.
Well, I'm just saying. Yeah. Well, out of the 6 that you chose, you were right there with 4 of them.
And I would say that's a good chance of that continuing into 2026 too, not to get ahead of ourselves here.
I was going to say, don't get ahead of us.
That's right.
Well, let's scoot to, because this has certainly been an interesting topic of discussion on taking stock throughout the 2025 episodes of Taking Stock. Interest rates is the next up on our Buckle Up 2025 Taking Stock predictions. You said looking for 4 quarter point rate decreases near the second half of 2025, and we know that there were
3.
Very close to it.
So 3 of them, and they were in the last, almost basically the last.
Not even a quarter. The last
quarter of the year. Yeah. So, and again, I'll take the check mark on that, I guess, but still question the fact whether they were needed or not, because we will get to that here in a minute. But the economy was much stronger than I expected it to be in 2025, so we'll get to that though.
Well, and then you just shared some news with me via some text messaging within the last 48 hours regarding the Treasury bond yield and those kinds of, some of that information.
Yeah, I mean, go ahead, sorry.
No, well, and so the forecast, you had 10-year Treasury bond to drop to 4 from the current 4.5. Where did it end up?
It ended up at 4.15.
Right.
We hit 3.95 during the year, though. So
that's it.
Once again, I'm not sure we belong there, but we did hit it, though. So
that's a yes.
Okay. Yeah. I'm trying to be fair. I said it to you earlier. Sometimes it's better to be lucky than good. So yeah, this is a fun exercise, but at the same time, it's if you're coming in close on a bunch of these, you probably have your fair share of luck too. So I'll take it.
Well, you said it, better lucky than good, but I think you have to be pretty good too. You were very complimentary at the outset of this episode, so I have to at least try to return a favor.
I appreciate that. That was my goal.
Without a doubt. What was that about the checks in the mail?
That's right.
I guess now I got to send one to you. That's a whole different story. But no, you know what? Going through this with you, not just this exercise, but it is an exercise every 2 weeks when we sit down and record it. And I never fail to learn something. I also am pretty good at forgetting what I learned.
Yeah.
Have to make you repeat some of the lessons.
It's repetition.
But it's been eye-opening to see and hear. I think it's fun when somebody says this is going to happen, and then it does. And that's a lot of what you've shared in these last 2+ years with Taking Stock is like information. Look for this to happen, and it pretty much does. Whether 3.95 instead of 4, or 4.18 or whatever it is instead of 4. Yeah, that's saying look for this, and there it is.
I mean, if I'm talking to my client, I don't say these things.
Right.
I say I'm looking for a strong stock market this year. I'm looking for a strong economy. I'm looking for stable to lower interest rates. I'm looking for lower inflation. I'm looking for normal. Those are the kinds of things I say. So if I'm trying to give you a prediction for 2025, I'm going to say I think 2025 is going to be a good year, and these are the reasons. I'm not going to say to you, I think the stock market is going to hit 6,900, and I think
right.
But
we do that for the fun part.
We do it for the fun part. Yeah, I'm still 100% worried about the trends. What's the trend going to be? And if I can look at 4, 5, 6, 7, 8, 9 different things and say this is what I believe that, and 7 out of 9 of them, this is going to be the trend. This is why I'm telling you I think this is going to be a good year, right? So, but again, I do enjoy this a little bit. It's nice to hold the fire under my feet a little bit. So,
well, not too much. Don't want to burn you.
Nah, that's true.
Because I need you back in 2 weeks.
There you go.
But interest rates, you also talked about the continued normalization of the yield curve.
Yep. Which is true. It did. Not nothing to get excited about.
How do you describe, for the listeners again, how do you describe what the yield curve is?
Yeah, we've been in an inverted yield curve. A normal yield curve means the further you go out into time, the interest rate that you're receiving should be higher. Okay. So you should be compensated for your time and for your risk and things like that. 2022, 2023, 2024, and even in 2025, we have an inverted yield curve, meaning we're actually kind of receiving more money on the short end or more interest on the short end than we are on the longer end. But this year or last year in 2025, that yield curve flattened out more, so it's a little bit, quotation marks, normal.
Yeah.
Okay.
Well, we got, we just did something, again, with this exercise because it's in fun. It's not as generalized as like what you said when you're sitting there. When you are sitting down with a client and talking about what you're looking for, it's much more generalized. So we don't have to get that detailed and that in depth, but we're just walking back through the predictions.
Sure.
Economic growth was the next major topic.
Yeah.
And you said you were looking for continued strength in consumer spending and confidence. Simple, spurred by lower rates.
True.
And we'll keep the economic growth in the 2 to 2.5% range.
Missed it by a mile. Because we finished at the end of last year. I think the last number was 4.3.
Yeah.
On the gross domestic product. So that means the economy was growing at 4.3% on a year-over-year basis. So that's that's the third quarter number, but we'll just go with that. So interesting to me that number was much stronger than expected. Number one, it was strong, period. Mm-hmm. But yet we continued to lower interest rates.
Right, which we talked about for months as those things were happening. It's like, this is going to cause this. Yeah. So what you talked about through the year, as opposed to 1 year ago, again, as you said, this is happening and this is what I expect to see, actually came true as time went on. It just wasn't, hey, looking for it 12 months ahead of time, and I know that's not your thing. So, again, this is all in good fun. Right. But a strong economic growth at 4+% as opposed to 2 to 2.5%.
Yep. Correct.
The scary factors we won't go into. We'll move on to the next.
Some more interesting.
Actually, I'm going to skip what we had as the next one. I'm going to skip and move to the last one, which was inflation, because I tie that more to the economic growth. Right. If that makes sense, right?
It has a direct impact.
Okay, so let's talk about the inflation forecast. Continued strength in the economy will prevent the Federal Reserve from achieving a 2% inflation goal. And that was probably your most far out forecast.
You like that one, huh?
Gosh, you know what? I don't think the Feds are going to get to 2%.
Yeah, I dug deep for that one.
But what did I hear today? Like, it was actually, this was the consumer price index.
Yeah, which is
2.7 to 3. So that's
got it.
It's still growing. Inflation is still there.
But interesting enough, it's below 3. It was 2.7, and they were looking for 2.8. So it was actually, not only was it a good number,
Chuck just flipped thumbs up.
Got the thumbs up, and it was less than expected. So I'm happy to see that and hope it continues.
So a topic of conversation coming up in a future Taking Stock episode is how the media reports that.
Yeah.
Because you know what I heard today? Mm-hmm. I didn't hear we were a little bit lower. Mm-hmm. They were expecting 2.8, it was 2.7. What the media reported is, so prices were still higher. Well, tell me a year in my lifetime the prices weren't higher from year to year.
Not a good year.
So 1930 was bad, but that wasn't during my lifetime. But anyway,
you're right. The way the media reports certain economic numbers and certain results is, as you alluded to, probably a couple. Well, the good news episodes, honestly. So
the good news is you hit 2 bullet points on the inflation forecast, one of which was the continued strength, and they won't hit the 2%. And guess what? Look for inflation in the 2.5 to 3, and 2.7 is right there.
There you go.
So in the most recent report. So you got 2 check marks, and we will close out the review of 2025 with unemployment numbers
Yes.
And your forecast was, again, referring to the continued strength in the economy. We'll keep unemployment near the natural level, around 4%.
Yep.
Did anything get reported different than that throughout the year?
Yeah, well, I mean, we actually, unemployment trickled up a little bit because I think we started the year about 4.1, and I think the last number I saw was 4.5. So it moved up a little bit, which, you know, and again, in fairness, and again, another whole show.
Is 4.5 near 4%?
Very much so. I mean,
your forecast was. But again, this might be, pick the ball up and go to the next tee box.
Well, there's 3% unemployment, 4%, 5%. That's a pretty good spread.
So you're still in the 4.
If you get to 10% unemployment, you got a problem. Okay, so I mean, hopefully, we had 20% unemployment in 2020, right?
Well,
so there is a difference. But here's the point: there's what's known as the natural rate of unemployment in. Different economists would probably give you a slightly different number, but if you're in that 4 to 4.5 range, that you're pretty much at or near the natural rate of unemployment, at least back in the Stone Ages when I went to college. That's what was considered. Who knows? People like to change numbers based on where they are, but it's. I'll go with close enough. How's that sound?
All right. Well, and we're going to take 1 minute.
Okay.
To wrap this all up.
1 minute.
With the Latin, what you're going to get to say, I want you to give us kind of a summary, and lead into the fact that our next Taking Stock episode, we'll have some fun with the 2026 predictions, but we won't get into those today. However, the last final note under the unemployment category, the lack of qualified workforce will put continued pressure on wages. How did wages end up looking? Because I know there were some reports as the year closed.
Yeah.
Wages were higher.
That's right.
Which was, people wanted higher wages. So is that a good thing?
It depends on who you are.
Well, I mean, what was the pressure? Continued pressure on wages. Was it going to continue to keep the wages down?
If you're getting higher wages and you're the employee, you're good with that. And hopefully that also continues to help spending, that continues to help confidence, that continues to help retail sales and all that and it helps your gross domestic product.
So the pressure was on the employers to pay higher wages due to the lack of qualified or lack of willing workforce even in some cases, right?
And what's the pressure? If I'm having to pay more in wages, the pressure on me, if I want to keep my margins and things, is... The pressure is to raise prices so I keep my margins, right?
We covered that in the economic growth.
There you go. That's right. So it's
summarizing the 2025 economic year for taking stock listeners, how do you?
It was a great year. It was a great year. The market was up. The S&P 500 total return index was up 17% for last year.
Right.
Okay. The economy stayed strong. The consumer stayed strong. Interest rates stayed low. Corporate earnings stayed strong. Actually, very strong toward the end of the year. So I'd like to see some carryover. So for 2025, that's one that's going to go in the books. That was a good year.
Outstanding.
Yeah.
So, and for investors, because that's a lot of. The economy and what drives the economy, the businesses and all that, and what happened with the consumers. Our portfolios, we made money, right?
If you're in the right place, you made a nice chunk of money, yes.
So
all your 401ks out there, if they are appropriately allocated, you should have done pretty well last year.
Outstanding.
Yeah.
Well, thank you to the listeners for joining us for another episode of Taking Stock. We look forward to having the listeners back again for the next episode 2 weeks from now. But mostly I'm looking forward to having you back, and we'll take the first few minutes of the next show and say, here's the things.
Sure.
And we'll include the housing market, because we didn't do that in 2025 for some reason. I don't know why we bypassed that.
We can talk about it if you want to.
I
don't think it's going to be too exciting, but we can talk about it.
Well, who knows? But,
but no, it was good. it's there's already been a lot to talk about in 2026. So, yeah, next 2 weeks from now could be very interesting.
Well, time flew today, and I know some of the things we probably should have talked about today we didn't really get to. That's my fault.
No.
Sorry about that. But
It's a good exercise.
thanks for sitting down with us today and sharing, sitting in the hot seat,
Yeah.
taking the heat. What was the final tally here? Wait a minute. I got 3, 6, 8, 10. Let's see, there's 2, 4, and 8, and 13. Well, hey, 10 out of 13, basically. If you go by every one of the bullet points, 10 out of 13, you were right there.
I'll talk to Caitlin Austin and see if I get to keep my job or not. How's that sound?
Check with them.
I'll check with them.
All right. Well, you can. Whatever they decide, I'll still have you back in 2 weeks, and we'll do another episode with or without their approval.
Well, if they fire me, we can do an hour episode if you want.
That might be a different kind of topic.
Might be very different.
Yeah. So, well, hey, Art. Seriously, thank you very much. Happy New Year to you and all of the Jarvis Global Investment clan. Looking for a very prosperous 2026.
Hope so. Thank you, Chuck. Appreciate it.
You're welcome. And thank you, listeners, for joining us. That is all for Taking Stock, episode number 65. We'll be back in 2 weeks with another episode.